Welcome to Forecasting for Success. My name is Dr. C. Adam Callery, and on behalf of the Chicago Minority Supplier Development Council, I welcome you to this Small Business Development Series. Financial forecasting is a skill all business owners should develop. It is an art, and as an art, it is a technique that can be learned through repetition. In other words, practice, practice, and practice. More importantly, you want to build a forecast that is relevant to your business. I will start off by summarizing a key few concepts that will be presented in today's discussion. Before beginning, I want to stress the goal is not to be precise. Your goal is to think through possible scenarios that could become a reality in the marketplace and develop the ability to estimate how your business would perform given a certain scenario or a certain situation. Looking primarily at your financial measures that you are familiar with, revenues, costs, your level of profit. At the heart of any good forecast, in this case, at the heart of any good financial forecast, are the assumptions that you'll make about the future direction of the marketplace, as well as the future direction of your business. We usually call that your vision. So I want to take a step back and share one more thought with you. As I mentioned, this is all about practice. The more you do a forecast, the better you get to know your numbers. What I mean by that is the size or the magnitude of your cost. As you do forecasting repetitively, you get a chance to understand what the numbers should look like normally, so that when there is a situation and you see the number seems to be higher than it normally is, then more than likely it is. And if it's a cost issue, you want to be able to respond to that appropriately and take the appropriate steps to correct that situation. So forecasting is not just looking into the future and thinking about your aspirations or what you hope to become, but it's also about getting better at understanding what you have done in the past, how your business has responded in the past, and what the magnitude or the impact of your decisions have been on your business historically, whether 1 year back, 2 years back, or even 10 years back, depending on the history or the legacy of your business. There are 4 items that we're going to talk about today. We're going to define financial forecasting. We're going to define your business type. And what I mean by that, we call it a business model, and we'll talk more about that. It means how you actually earn revenue. Third, we're going to talk about forecasting benchmarks or assumptions. These are critical to doing a forecast. You cannot do a forecast unless you have some assumptions about how the business is going to operate, or how the business is operated, rather, and also some assumptions around what you think the market may be like 2 months from now, 6 months from now, or even 24 months from now. And last but not least, we're going to pull it all together. We're going to summarize it and at least give you some basics on how to create your first forecast. In addition to those 4 areas, with all of our sessions, we always have some underlying session objectives. So our first one is this. I want you to get to the point of being able to contrast the common business types that influence the business model. What we mean by that is that if you're a service business, you're different than a retailer. If you're a retailer, you're different than a manufacturer. Those 3 types have different characteristics, different traits, and as a result, they'll have different cost profiles. We also want to explain how to use the income statement as the basis for your forecast. Then we're going to demonstrate how to develop assumptions to support the financial forecast itself. So those are our 3 session objectives for today. So let's start off by defining financial forecasting. To do that, there's 2 questions we're going to answer in this segment. What it is not, and what is financial forecasting. So let's start off with what it is not. What it is not is a random guess. We don't want you to walk into financial forecasting by just hoping that the business is going to do well or assuming that everything is going to continue to move in the same direction it's been moving over the last year. So let's say things are going well. We cannot assume that things will continue to go well. We've already experienced that with COVID. Something can happen out of the ordinary, and we have to be ready for that. So when we're thinking about forecasting, we want to think about the what if. What if something else happens that's negative? What if something happens that is positive? How should I respond? How should the business respond? So these are intentional questions that we're trying to answer. A belief that successes of the past is a direct indicator of the future, or failures of the past will continue unchecked into the future. So this is also an important piece. As we move forward in the business, we gain in maturity, we gain in knowledge, we start to understand how the business operates. So we can't assume that we'll make the same mistakes again in the future as we may have made in the past. And all business owners make mistakes. So again, we're not being negative here. But if I made a mistake in the past, more than likely I figured out how to solve that issue, and that's why I'm here today. So we don't assume that we're going to make the same mistakes in the past if facing the same situations. A foregone conclusion that life is unpredictable, so why bother? Most people I speak to who are in the small business community will say, I can't predict tomorrow, so why should I even worry about predicting the future? We don't want to assume that. We want to be able to say that as I mature in the business, I will be able to foresee issues or problems before they surface and be able to make corrective actions before it becomes damaging to the business. Or as I mature in the business, I'll be able to see opportunities. So therefore, I'll start to position my business to be able to take advantage of those opportunities. So again, we're not stagnant. We're always dynamic. We're always moving forward, and we're always thinking positively, but we're also being realistic as well. So what is a financial forecast? It's based on assumptions, and we're trying to estimate. Again, we're not trying to be precise. We're trying to estimate what we think the future may be. In most cases, most of us who are small business owners are going to be conservative, and that's a good thing. Our vision and our dream may be aspirational, but when we're running a business and we realize how much things cost sometimes, we get conservative very quickly. So that's a good thing. More than likely, our first assumptions are going to be conservative. So you make those initial assumptions and then move forward to try to create a forecast around that. Should be informed by historical data and past practices and experiences. So I'm basing this on what I've already seen, I've already experienced. So again, we're not guessing at this, it's not random. We're basing it on our past experience. It should be informed by a relevant assessment of current competitive and general market conditions. That sounds like a lot, but all it means is that I'm being observant. I'm looking around, doing a head count. How many new competitors am I competing with now that I didn't have to compete with last year? Does it look like unemployment is going up? Does it look like unemployment is going down? Does it look like interest rates are rising? If interest rates are rising, what does that mean to me? Well, if I'm looking at maybe securing a line of credit from the bank, then rising interest rates is a concern because it means that our costs are going to be higher. I need to plan for that if I'm able to secure the loan. Business is a going concern. Now, this is a phrase that bankers use and accountants use all the time. It means that I expect to be here tomorrow. So when you're doing a strong financial forecast, you don't want to walk in going, I'm failing. The business is not going to be here tomorrow. You're thinking about, hey, I'm going through some rough times, a rough patch right now, but I'm going to overcome this, and I will be here next year, and the business will be prosperous next year. Or things are going very well right now. I plan on taking this business forward for another 5, 6, 7 years. Going concern. I'm planning on making decisions in the future that will make sure the business is going to be profitable and successful. A method to minimize business risk. So what I'm trying to do is I'm trying to minimize business risk. We define business risk as trying to minimize a financial loss. I can never eliminate losses. There will always be a situation where I make a decision. I may have selected a client that I thought I could work with. That client, for whatever reason, doesn't pay me. So now I've taken a loss on that contract with that client. It will happen. But what I'm trying to do in the future, though, is minimize that. Maybe I'll spend a little bit more time interviewing the client before I take them on. Maybe I'll spend a little bit more time really understanding my target market, my target audience. If I'm a retailer, making sure I'm going after those people who really can afford to pay for the items that I'm selling versus just trying to do a shotgun approach and bring anybody through the door. All right? So again, this is a intentional activity that we're doing, and one of the big things we're trying to do is minimize financial risk to the business. Mistakes to avoid when forecasting your financials. One is not to forecast at all. We've already talked about that. You don't want to just throw caution to the wind and say, I'm just going to keep moving in the direction I'm moving in and hope that everything works. Failing to account for marketplace trends. Everything's going well right now. The business is booming. People are coming through the door. What I'm not noticing is that competitors are noticing that I'm doing well, and they start to take action. They start reducing their costs. They start offering more services. They start enticing my customers to come to them. And now all of a sudden, my sales take a downturn. Not justifying forecasts with facts or data, meaning I'm not using real facts, I'm not using real data in my forecast. I'm just guessing, I'm thinking, I'm hoping, versus I'm really taking the time to look back at my data and deciding this is what's really happening with the business. Maybe I should use this data as a gauge to see whether or not the business is moving in the right direction. Underestimating operating and maintenance costs. This happens a lot, especially if you're in a manufacturing capacity, or maybe you're in a logistics business where you have a trucking firm and you never quite estimate the fuel cost just right, or you never quite estimate the tolls that you're paying as you're going up and down the highway. And you look up, all of a sudden there's higher expenses coming in from those two sources. Or you didn't fairly account for overtime for these drivers. So therefore, the profit that you estimated is no longer there because now it's being chewed up in overtime. And again, that can happen. So by doing forecasting, we can create a scenario where we say, what if overtime is higher than expected? What's going to be the hit on our profitability? What if there's an increase in toll charges on the highway? What's the impact to our bottom line? We can start to think about that, and if we start to get wind that overtime is higher than expected, or our toll costs are going to be higher, we can start to make adjustments again in our business so that we can get ahead of that, so maybe we can protect our profitability. Overestimating revenues. This is when we are overly optimistic about how well the business is going to do. And all of us suffer from that. I used to be in real estate where I had an apartment building, so I was doing some property management. And those very first months, when you're trying to get the business up and running and you're trying to get that apartment filled up, you're overestimating how much you can charge in rent, only to find out that the market ultimately will dictate what that rent amount can be. And therefore, then you have to be realistic and scale back your ambitions for that particular building. So again, overestimating revenue happens all the time. You shouldn't get mad at yourself about that, but you get excited as a business owner. You're hoping that the business is going to do well, and sometimes when you start to see higher revenues coming in, you start to overestimate the potential. Failing to anticipate seasonal fluctuations in consumer demand. Best example is as during the holiday. We all know that between October and November, a lot of people are going to be in the stores, especially retail stores, buying for Christmas. When January hits, they're going to stop buying. If I'm a retailer, I have to understand the pattern of purchasing. So I have to understand the pattern of my customers so that I don't end up buying too much inventory in June, July, and August, thinking that sales will be as high as they are in October and November. So that's what we mean by seasonality. I need to really get a sense of when people buy, how often they buy, and will they be buying from me in the future. Failing to account for risk associated with entering a new market. So I get excited because I think there's an opportunity for me to expand my business by going after a different clientele, a different customer. And so I say to myself, hey, why not? Let's give it a shot. There may be some new risks there because that customer may have different demands on my business than my former customer. Those demands may lead to higher costs. So I do need to anticipate that and plan for that. I'm hesitant to look at the market conditions beyond 12 months. I've been doing this for about 12 years, and I've talked to a lot of business owners, and many of them will say it's hard for me to look 3 months out, let alone 6 months out. And you're asking me to look 12 months out? You're asking me to look at October or November of the next year and estimate or think about what the market may look like? And I'm going to say, yes, we are asking you to do this. I had a conversation the other day with someone, and I asked specifically, do you believe you're going to be here next year? I mean, physically, as a person, are you going to be here next year? And they were sort of hesitant to answer the question. I said, well, that's the first part of forecasting. You have to believe that you're going to be here next year. If you don't believe that, you can't do the forecast. So you have to be able to embrace the fact that you're going to be here as a person. The business is going to be here in the next 12 months. And therefore, I need to be able to feel comfortable in making decisions that are going to help lead this company for the next 12 months. And hopefully 12 months from now, I'll be able to do it again. 12 months after that, do it again. So, how do we approach conducting a financial forecast? Ultimately, that is the question. The way we do that is by preparation. We investigate the competitive strengths of our new competitors. We research developing trends in our industry. So if I'm in retail and I'm selling clothing, I track what's happening with clothing. If I'm a restaurant owner, I track what's happening with the restaurant industry. I question fluctuations in the strength of consumer demand for our products and services. I assess the impact of economic trends and reports on the interest rates and unemployment rate. I evaluate the impact on operating revenues, expenses due to technological changes in the marketplace. We all carry phones. We know that mobile technologies are around us. Those phones, those apps are changing the way people are doing business. I need to understand how my customers are using these new technologies when it comes to buying my services and my products. So that concludes this segment of our session.